Welcome to Options Brew TV midday market shot. Here's the market recap right now at this time of day. Dow Jones down 18.14 to about 33,400 and change. S&P's up 11.91, 4,091. NASDAQ up 122 to 13,800. The Russell, which is the small cap, up 8 points to 2,200. And one of our favorites, the VIX, $17.20, up 4 measly cents. What do you think about all that craziness? Anything stick out?
Well, the VIX, that's one of those numbers that we've been talking about for a long time here. It felt like we were months on end of rallying, but we couldn't get the VIX below 20. And now we finally settled in, like you said, trading around 17. So I think what I wanted to look at today was, we're in such a low vol environment relative to where we've been. We like selling vol, we like selling, collecting credits and all that, but now might be an opportunity to buy vol. And given where the market is at some of these highs, I wanted to think about what it would look like to start buying vol, and particularly buying vol, buying options as a form of protection. Sort of given where we are at some of these relatively elevated levels. The Qs have rallied back, the SPX has rallied back. So let's think about buying vol for protection here.
Ooh, it's unlike we market makers to be buying much of anything. We were like typically sellers of stuff, right?
Well, exactly. But, when we're talking about these unprecedented lows in the VIX, it almost feels like it's time to start thinking about buying some options here.
All right. What do you have in mind?
So what I want to kind of walk through here is two different types of protection, and comparing sort of what buying options in the VIX would look like as a protection versus buying, options directly against, say, an SPY or an index like that.
Okay.
So as we well know, the VIX is the fear index. It's calculated based on the 30-day implied volatility of SPX options. So it tends to move in the opposite direction of the SPX. There's something like a negative 0.8 correlation between the two of them. It's not perfectly one-to-one, but SPX goes up, VIX tends to go down. So in one case, on the SPX or SPY ETF, we're going to be buying downside puts as protection against a downward move. But on the VIX, we're going to be buying calls. And so we're going to be buying calls to offset an overall portfolio scenario, so that those would go up in value when the market goes down. So I'll go ahead and share my screen and sort of walk through two different examples that we've got here.
So, yeah, let's see. Okay, good.
Let me actually start with SPY, because that's sort of the intro level to think about here in terms of protection.
And just as a note to the viewers, the SPY, it is what, 1/10 of SPX? Is that right? So if you do 10 options in SPY, it's to 1. I guess I should say it the other way. SPX 1 option, SPY 10. Is that right?
Exactly.
Okay.
And so SPY the options on SPY are 100 shares of SPY, which is 1/10 of the SPX.
Got it.
Sort of
Good.
Depending on your size, either product might make sense. The tightness of SPY markets, though, is interesting. In some ways, you can almost get better execution sometime trading the smaller product.
Sure.
That said, massive institutional trades still tend to flow through the SPX.
Right. Okay. And we're out at, you've chosen 43 days, I believe, right? Is that what we're looking at?
Exactly. I went out 43 days to the serial May expiration here.
Okay, and that's right up here. 21st. So there you go. And when Mark says serial May, that just means the 3rd Friday of the month, right? That's the normal expiration before we were introduced to a bazillion weeklies. So
exactly.
Yeah. Okay.
So I think, isn't it the Friday before the 3rd Saturday?
Yeah, it could be. They might have changed.
Or are we now the 3rd Friday? They made a switch a couple of years ago.
Well, they might have, and that just proves how old I am, because I didn't know they made that switch. So when I was on the floor, it was always the 3rd Friday. But you might be right. They might have changed that. I'm gonna research that and get back to you.
Okay. Well, because options used to expire on a Saturday.
I think they probably still do.
Have to come in and process them, everything on a Saturday.
I think they still probably do. I just remember, and I'm sure you remember too, the feeling was that we only worked Monday and through Friday, man. When it expired, I don't have to do anything on Saturday. Occasionally I did when something went kind of weird over a Friday at close, and I had to force exercise a few things, but.
Exactly. Now I think they cut you off at 5 o'clock on Friday, though.
Is that right?
I think there's a
Yeah.
hard deadline, and after that you have to pay some huge penalty. But it's a whole process.
Got it. Okay. Sorry
Anyway.
about that sidetrack, but go ahead. You're in Spider, 43 days out. We showed that. What are you gonna do here?
43 days out. So, we have, let's imagine we have 100 shares of SPY here. So trading at 408, this is about a $40,000, investment, $41,000, just shy of that. So we want to think about getting protection for the next 43 days here. And I'm going to look right at the money. And if we were to buy direct protection on SPY right now, the next 43 days, we'd spend about $778.
Okay.
So that put is offered at $7.77. We'd buy one, which represents 100 contracts. We'd spend about $780 to get protection on this level through the next 43 days in May.
Got it. Okay.
So, that's what about the cost of perfectly protecting our SPY portfolio for the next 43 days is going to be.
Got it. Okay.
So I want to compare that to what you could get if you were to spend $780 in the VIX.
Okay.
And as we mentioned before, VIX and SPX are relatively well correlated.
Right.
And I was actually running some numbers a little bit before this. And in general, the ratio of SPX moves to VIX moves is about 8-to-1.
Okay.
So if the SPX goes down 1%, we'd expect the VIX to go up about 8%.
Okay. So you say that again. I might have missed that. Say that one more time. So the relationship is what? Is
about 8-to-1 in terms of percentage moves. So
got it.
SPX goes down 1%, we would expect the VIX to go up about 8%.
Okay, perfect. Yeah, and we'll make it clear. These move in opposite directions generally.
Generally, not always.
Yeah,
there are always interesting effects. Volatility does go both ways. So, there can be times when a rising market is a more volatile market. But in general, like I said, about a strongly negative correlation here, and it's about 1% down in SPX, 8% up in VIX.
Perfect. Okay.
So if I want to think about spending those $780 that I have in the that I got from the SPY, if I go in the at the money VIX, conveniently this 21 strike in May, this actually expires 2 days before, but approximately the same expiration date. If I pay $250 for the 21 call, I can buy about 3 of those.
Okay, so 3 times 250 gives you about that 750-ish, $70-ish, right?
Right.
Okay, got it. So you get 3 of those.
Let's imagine a scenario where the market's going to go down about 10%. Market goes down 10% in the SPY. I'm going to be offset, and I'm going to make about $4,000 in that put. Down 10%, $41,000. About a little over $4,000 that we're going to make.
Okay.
In the VIX, if the VIX goes up, if the market goes down 10%, we expect the VIX to actually go up 80%.
Okay.
That same -8 correlation there,
right.
Or -8 ratio, I should say. So that's going to bring the VIX up to something like 38.
Yeah, that's a big move. So 80% of, let's call it $17. Is that what we're saying?
It's actually, so the forward price in May is about 21.
Oh, that's a good point. Yeah, so it's about, exactly right. Okay, 21 times 1.8 gets you to what? You said 30. Yep, 37.8. I'm checking your math, Mark.
Thank you.
I know you've already done it though.
Making sure I can read my handwriting here from these notes.
Right.
But actually, you brought up a very good point though. So right now the VIX cash index is trading around 17.
Yes.
So the VIX is, mind-bending in the way some of these things work together, but relatively what the VIX cash is saying is it's looking out 30 days from now. What are the SPX options that are 30 days from today? Where are they priced in terms of volatility?
Right. Right.
The value of that May 19th future and option, which the options are based on the futures that are expiring on May 19th, that settlement print on May 19th is going to look at the options 30 days out. So on
Right.
May 19th, we're going to be looking at, something like the June 19th options to determine that value. So that's sort of why you see this upward sloping term structure here, that while we are at a relatively low level right now, we're at that 17 cash figure.
Yep.
This term structure going out is expecting higher volatility in the future.
Right.
And so, the expiry value of these options is going to be based on the 30-day forward volatility on May 19th.
Got it. Okay. Yep. It is a little tricky, but each for the viewers, each one of these expirations has its own future. Isn't that right?
That's correct.
Yeah. And then you price each of those months off of that future in terms of theoretical value.
Exactly.
Okay. Yeah. It's a little tricky. The VIX is a little bit tricky. But keep that in mind. You're not running theoretical value in the marketplace isn't being run off the cash. Okay, we just want to make sure that's clear. It's being run off the future of each of those months.
And which is why the at the money in this case is 21,
Yep.
as opposed to the 17 where the cash is trading right now.
That's right. Okay, awesome. So what are we making now? We got digressed there a little bit, but we are making. You said this is going to be an $38 price if the SPX goes down 10%, roughly. Again, it's a little bit thumbnailing it.
It's a little bit thumbnail, but if VIX goes to 38 on that sort of 8-to-1 ratio in a 10% down move, we're at 38. Those options are going to be worth $17.
Okay.
38 minus 21, they're going to have $17 of value.
Right.
So holding 3 of them, you're going to be holding $5,100. So compared to the $4,000 that you made in the SPX on a 10% down move in that put, you're gonna have almost 20% more cash if you had bought VIX calls instead.
Right, right. So you would get. Let me make sure I get this right. It's the price. It's going to be $17. Is that what you discovered this option?
I think the final value of that option will be about $17 of intrinsic value with the VIX at 38 on May 19th.
Okay, and then that's less in terms of profit, that's less the $250 we pay for it, right?
Correct. So we spent $750, $780 in both cases. In the VIX case, we end up with $5,100, and in the SPX case, down 10% is that option is going to be worth $40, and so $4,000 minus the same 700.
Sure. Now, do we make 3 times this? So it sounds like we make $14 per option. Is that correct? And that's times 100 each time around. Oh, I get you. So times 3 is where you came up with your money there. Okay.
Exactly.
Okay, gotcha. I might have had an extra 0 in there. I'm playing with the calculators. You're talking.
I
was hoping I had an extra 0 in there. Okay, good. All right. So they're fairly similar, right? In terms of, choosing one over the other.
Fairly similar. I think there's some really interesting benefits to one or the other. In some ways, VIX is gonna, like you mentioned actually earlier, that it's not perfectly correlated. So there could be scenarios where vol goes up just generally based on overall fear sentiment in the marketplace, while the market's also rising. So you might actually make money on both of these legs. This is assuming you're long 100 shares of the SPY that you're trying to hedge.
Sure.
So vol could come up. Vol could also go down, of course, but vol could go up as the market goes up here. So you could win on both legs. That wouldn't necessarily be the case at expiry in that put. In the interim, of course, that put could gain value as vol goes up also. But you could see a scenario where vol is also higher in May as the market is also higher.
Okay, good.
So that's one benefit. I'd say a drawback is that it isn't a perfect correlation here, right? One of the benefits of buying a direct put to protect yourself is where the underlying goes, that put's value is going to go. That those are perfectly directly linked. Whereas the VIX hedge is a little bit more of a macro offsetting, theoretical sort of baseline behind it.
Sure. So I don't want to put you on the spot on this episode, but let's think about this for next time. Instead of buying, extending long premium, both of these, I wonder if there's a way we can use both products to create a long short. What I mean, but so that we can finance the long with the short. You know what I mean?
Interesting. Yeah.
Yeah,
I mean, there's certainly ways, and I think generally, in the portfolios that I manage, I like to use VIX as a relatively cheaper offset because
sure.
it is cheaper. And I think thinking about ways to even further reduce that cost by selling it
Yep.
definitely could open up some opportunities.
Yeah. I mean, but just intuitively, when I'm thinking about it, I know I don't want to sell the VIX call in this part of the hedge. I think, for whatever reason in my mind, the VIX seems to have the potential for a binary move in the marketplace. I know it affects the spiders, but I don't know. I just feel like sometimes the VIX can get overdone, so I don't want to be on the short side of that one.
I think that's sort of the advantage of being long the VIX is that
That's
you're
right.
very much long convexity.
Yeah.
And that the way at which the pace and sort of velocity at which it'll move is far greater than
Yep.
the underlying. So,
Yep.
staying
Uh,
exposed to that sort of like convexity tail, I think is definitely the leg you want to be owning
I
here.
agree. I agree. I think I have that as my long lead. I got to think about the spider side of it to get the shorts built in. We'll get it right. So
Yeah, I
that's
mean, I
good.
think if you're selling much in the spider, you're going to end up sort of doubly long there.
Yeah.
If you, but you could potentially sell some upside calls in the spider to finance your VIX.
Right. That's what I'm thinking, more of a spider call spread or something. Who knows? You know.
Yeah.
So
All right. Well, that maybe sounds like a way to pick up this trade next week. I like
yeah,
it.
let's think about it. You and I will circle back and figure it out. So okay, good. Well, thanks, Mark. That's some good stuff. All right, Mark. Well, thanks again. Have a great week and weekend.
Cool. Thanks, Lex. You too.
All right.